what is value investing? In today's video, we're going to break down just what value investing is in simple terms we can all understand so that you can make an informed decision of whether or not you should implement that strategy into your financial plan. So let's get into it. Value investing is the art of buying stocks which trade at a significant discount to their intrinsic value. What is that? Well, kind of really need to understand what intrinsic value is. The value, or it's the price at which a company is supposed to be trading at based on its fundamental, not based on the market value, which is whatever it is selling at that people are willing to pay for. So the idea behind value investing is trying to identify what the intrinsic value is for a company and buy a company or buy a stock, buy shares of the stock when the intrinsic value is significantly higher than the current market value. That indicates that this company or this stock is on a discount, that it should be trading at, say, for example, $200. But if the market value has it at $100, that is a 50% discount that you should be buying and snatching that up. There is a high degree of probability this stock and market value will align with the intrinsic value. Typically, the intrinsic value will not adjust and shift too much. It does move based on the actual performance of the company. Everything modifies, everything changes, everything ebbs and flows and is flexible, especially with the stock market. Past performance does not guarantee future results, but the intrinsic value of a company is based on the company's fundamentals. So its sales, its power, its cash flow, its products, its market sector capital utilization, how big is the company, the economic moat that is around it, how safe is the company from geopolitical factors. It all comes together in the idea of the intrinsic value of the stock, the actual trading price that's supposed to be at. If the market value is significantly lower, that market value will eventually correct itself and line up with that intrinsic value. And if the market value is lower, value investing will buy it because they understand that this stock has a value to create a gain for that investor because the intrinsic value suggests it should be higher and therefore the stock's on a discount. Contrary to that, if the market value is significantly higher than your intrinsic value, then that stock is overpriced. Just like if it was underpriced, if it's overpriced, eventually the market value will correct itself to the intrinsic value. Sometimes it's wise to still buy a stock and to pay up for a stock, even if it is overvalued, but that is some things that you need to assess for yourself, determine your risk versus reward tolerance level, and understand your investment strategy and what your game plan is, because you really should have an investment strategy if you're investing. If you got value from this video, hit that like and subscribe button down below. Join the mission to help 1 million people achieve their financial success. And I'll see you on the next video.
The information contained in this video is for entertainment purposes only. I am not a financial advisor, a tax professional, or anything of the kind. The ideas, the concepts, the thoughts in this video are my personal opinions, my personal thoughts, and they are not suggestion or advice for you to go out and do anything with it. I highly encourage and suggest that you do your research before you do any kind of financial decisions or tax preparations. Before you do anything, please do your research and consult an actual professional.